I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a guy that runs TF Metals Report. Actually, a fantastic time to have him on because, the markets are plunging. The dollar is spiking. It looks so weird what's going on. Craig Hemke is the man who runs TF Metals Report. Craig Hemke, thanks for joining us today on USAWatchdog.com.
Greg, it's always a pleasure, my friend. I think we got a lot to talk about.
Well, you told me in the pre-interview that the Fed is backed into a corner and that this trade war, or actually we're just fighting it back. We've been screwed for so long in the trade deals. That's just unbelievable. And people are like, I can't believe he's asking to drop all the trade barriers. Hey, let's drop all the tariffs. Donald Trump said at the G7. But it's more than that, just a trade war. Tell me what you think is going on and why you think the Fed is backed into a corner.
Well, the challenge in these things is always to look forward, right? You always got to kind of look ahead. You're supposed to try to anticipate where things are going next. I've maintained for years that the Fed can't raise interest rates. And what we mean by that is, of course, they can raise their own Fed funds rate. I mean, they can do whatever they want. But as you go out the yield curve, where the actual bond market takes over, buyers and sellers of U.S. Treasuries, the Fed's just not in a position that they can drive those rates higher for two reasons. One, I mean, the servicing of the existing debt, which is what, 21 some odd trillion dollars now, Greg, and growing by $1 trillion a year, though nobody really cares anymore. The servicing of that debt, I spoke with a guy by the name of Jim Grant doing an interview on my site about 6 weeks ago. Jim Grant, the publisher of Grant's Interest Rate Observer, they're one of the most renowned interest rate bond market newsletters in the world. He had done the math and he said for every 1% move up in the yield curve in general, because of course U.S. Treasuries have varying levels of maturity, every 1% move up adds $140 billion in service cost as a line item on the federal budget. So these people that talk about the 10-year note rate normalizing, whatever that means, going back to 6 or 7%, that would add what? $600 billion a year in interest service costs? And instead of a $1 trillion deficit, which is already implying, a 3% economic growth just to have only that level, we'd be talking $2 trillion a year or more. God forbid we get a recession, which we would, with rates that high. So the Fed can jack the Fed funds rate to give themselves some room to cut it, which is really all they're doing. But they can't see long rates move higher. For that reason, you get the increased debt service cost, but it's not just at the public level, it's at the private level too. Corporations, individuals, mortgage rates, car loans, student loans, credit card rates, everything would skyrocket and they'd crash the economy if long rates move higher. Now, on the flip side, if they keep hiking the Fed funds rate from here and long rates don't move higher, then you're going to see what we call an inversion of the yield curve, because a normally positively sloped yield curve, meaning that rates are higher for a 10-year note than a 2-year note. And they're higher for a 30-year bond than a 10-year note, right? The rates should go higher as you go out with a longer maturity. When the yield curve inverts and short rates are higher than long rates, that is always a precursor of recession. Anyone can look this up. The Fed can deny that. They can try to make the case that, oh, no, things are different this time. This is not the way it works. No, that is the way it works. So either way, if the long end, if the bond market sells off and rates spike, then the U.S. economy begins to crash, go into recession, and the next move for the Fed is to start cutting rates and talking about more QE. If more money continues to flow into the long end, I mean, the central banks have created $15 trillion at a minimum of QE, new fiat, in the last 10 years. If that money continues to flow into the long end looking for a yield, then that yield curve inverts. Short rates go to 3% while the 10-year note's at 2.5%. And again, you get a recession, and we're talking about cutting rates and more QE. So either way, the Fed has painted themselves into a corner. We have to anticipate that. We have to look forward. We have to begin to think, okay, if by later this year in 2019, that's the direction these central banks are taking, well then how will the markets look? How will gold and silver look? And that's what we are trying to decipher here in the middle of June.
If what happens if we have? I mean, Deutsche Bank just got downgraded by the Federal Reserve. They've been laying off thousands of people. They say 7,000 or more than 7,000, so it
Yeah.
could be more.
Yeah.
That's
Well,
not the sign of a healthy bank. They were talking about it, rolling it in with Commerce Bank, but Martin Armstrong says, ha 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 ha, Commerce Bank's a mess too.
yeah, they all.
Yeah, they all are. So, could they be forced into a situation where we have to have a debt reset? They call it a reset. It's really a debt reset, and currency is debt. So, currency reset too. So, are you at trying to anticipate any kind of a debt reset? A lot of people are still beating that drum, and that eventually we're going to have one. That's all there's to it. Go ahead.
That's probably the right way to put it. I wouldn't want to say, hey, there's going to be a debt reset by August 29th. I don't think that's probably the way you want to go with it. But it's pretty obvious to anyone that we're in this kind of parabolic Ponzi scheme. Of just the debt now globally is increasing at such an exponential rate that at some point it becomes unserviceable. And at that point, you get this reset that you're talking about. Specific to the European banks, that's all ultimately a function of confidence. You can go back to 2008 and watch what happened in Bear Stearns, watch what happened in Lehman Brothers. And, the risks were obvious to everybody in 2007, what was going on there, as the banks were all linked together. Remember, with the credit default swaps and the collateralized debt obligations and everything else. But as long as there was confidence in Bear, as long as there was confidence in Lehman from the counterparties to all these different risks, then the situation was able to continue. But look how fast Bear went from 60 to nothing, right? Everybody can look up a video of Jim Cramer from March of 2008 where, oh no, Bear Stearns is fine. Don't take your money out of Bear Stearns. And it went from 60 to 6 cents in a matter of days.
I don't want to beat on Jim Cramer. He said the same thing about Wachovia at $16 a share. Had the CEO on. It's fantastic. Also, Lehman Brothers. Oh, Lehman Brothers. I mean, you went in on a Friday, and by Monday it was $10 or $11, and on Monday it was $1. I mean, it was they were fighting delisting.
You can see this today, actually. The attempt to inspire confidence in Deutsche Bank. Anybody can pull up a chart. Take a look at the chart right now of Deutsche Bank. You can clearly see, at least to me personally, you can clearly see the heavy hand, the overt support of the Deutsche Bank share price at $11 US. That is about the all-time low that it came down to 2 weeks ago. And over the last 3 days, here this week, it has been clearly supported at 11. Why would, say, the Swiss National Bank and some of the other some of the other central banks that are involved overtly in owning equities, why would they be supporting Deutsche Bank? Well, because if Deutsche Bank begins to spiral down through 10 to 9 to 8, you get this crisis of confidence from the other banks that are all linked to Deutsche Bank in this daisy chain of counterparty risk. And we're right back to where we were in 2008. So at the end of the day, your question, some type of reset is coming because ultimately the system is unserviceable. The debt begins to grow so fast that you cannot print money fast enough to service all your existing obligations, especially when the economy begins to collapse and get another recession. So that's one thing. In the meantime, you've got all these other risks out there that confidence must be maintained in the system. That's why you've got to watch things like Deutsche Bank or Commerce Bank or Credit Suisse or any of these others, especially in Europe, because the European banks are all linked together, owning each other's debt, owning each other's, their counterparties to each other's derivatives and interest rate swaps. That situation could go from nothing, 0 to 60, in less than 3 seconds.
60 to 0.
60, another way to look at it. And so that's something that everybody needs to be monitoring very closely.
Gold, dollar. I want to start with the trade thing on your own TF Metals report. I perused it this morning, and you went, oddly enough, the trade war is dollar bullish, and gold's taking a hit. It's at 1275 or something like that. But yet, and I'm hearing from you, and I know you have TF Metals reports, so you're talking your own book, although you're not selling anything. But even Catherine Austin Fitz, who's not a huge a gold bug by any stretch of the imagination, is saying rich people are buying land, gold, silver, working businesses. They're buying stuff. And gold and silver certainly are stuff. Well, let's talk about the trade war and where you see that going and why the dollar is spiking and the gold's taking a bit of a hit.
Well, there are so many different reasons and rationale that you could come up with to say, oh, the reason Trump's doing this, the reason they want to increase these tariffs in a trade war is X. And I don't think anybody knows for sure why he's doing it. Whether it's just because he thinks that's what should be done, or whether there's some ulterior motive like penalizing the Chinese for having the audacity to begin trading crude oil in yuan a couple of months back. Who knows exactly the reason behind it? But what people need to understand is how the balance of payments works in a dollar-based system. There is a reason why we have this massive trade deficit. There's a reason why, frankly, we've shipped all these jobs overseas over the years to create this system where U.S. dollars get printed here to support our debt, to support our guns and butter programs of military spending and the Great Society. Those dollars get printed here, but then we buy everybody else's stuff because it's all manufactured elsewhere now. And in doing that, countries like China exchange their goods for our dollars, right? They're selling stuff to us, goes to your Walmart, if you will, and in exchange for that, they get dollars. All right, so the Chinese look around, all these other creditor nations look around, they go, okay, well, what are we going to do with these dollars? I mean, they're not really much good to us. We could sell them and buy some other currency. We could sell them, buy gold. We can, and obviously we see that happening. But most of the time, what they do is they take their dollars and they recycle it back into the U.S. and buy treasury bonds, providing a constant bid for treasury bonds, which is why the bond market has been in a bull market for the last 35, 36 years with rates consistently going lower because there is this nonstop bid for bonds, people wanting bonds, countries wanting U.S. treasuries because they don't have anything else to do. What else are they going to do with all these dollars that they get in return for trade? That's why there's this massive trade deficit that Trump lambasts and says is so horrible and we got to do something about it and American jobs and all this kind of stuff. Okay, fine. You want to cut the trade deficit in half? Then you're also going to cut the amount of dollars going overseas in half. And if you cut the amount of dollars going overseas in half, then you're going to cut the demand for U.S. treasuries in half. And if you cut the demand for U.S. treasuries in half, then the price of treasuries falls. And if the price of treasuries falls, that means interest rates skyrocket. And now we're right back to what we just talked about 5 minutes ago. If interest rates skyrocket, how are you going to service all the existing debt? The economy is going to crash. Even currently, the Congressional Budget Office and the Trump administration and the GAO and all these people, they say that we're going to run trillion-dollar deficits as far as the eye can see, all the way till 2028 and beyond. $1 trillion at a minimum. That all assumes a 3% GDP growth every single year for the next 10 years. Well, that's not going to happen. So how bad is the deficit going to be? $1.5 trillion? $2 trillion? If not only interest rates spike and the economy slows down, so tax revenues fall. That's why we got to consider it this parabolic Ponzi. I mean, the Ponzi scheme of constantly making new money to just simply, or printing new money to service the debt and try to come up with growth to keep the whole wheel spinning. That whole scheme is on this parabolic exponential growth rate that just simply isn't sustainable.
Could Donald Trump, and people, no, that'll never happen, but I'm not so sure that he wouldn't just say, okay, do what he did in the 90s with his own personal wealth and say, I need to cut this debt. We're going to get a haircut here. We're never going to pay this back. This is never going to happen. We're growing it, and we know we're never going to pay it back. Everybody in Washington knows it's never going to get paid back. So is he got the guy that's going to come in and say, okay, we're going to reset this debt?
I don't know, Greg. Probably not going to come out of that just from out of the blue. I know, but you never know. I mean, other things have happened in the history of monetary policy where changes are made just by fiat overnight.
He's not a dumb guy. He knows he went to Wharton Business School. People don't realize that. He understands the economy. He understands the Fed. He's not stupid. And I don't think Barack Obama understood the Fed. I don't think he understood the economy. I don't think George Bush, 43, really understood the economy that well.
No, I agree.
But
Greg,
he does.
I agree with you. There's no doubt about that. There's no doubt he understands it. I mean, he's grown all of his empire through the issuance of debt, right? So if anybody knows the value of that and going bankrupt or carving things off and declaring them bankrupt and negotiating with your creditors and all that kind of stuff, man.
I know.
He knows how that stuff works, man.
He puts them in a position where they have to make a deal or you get nothing.
Right. So, okay, that's fine. I mean, that may very well be where this is headed.
And when he was doing his deals, to get out of his slump in real estate, he didn't have nukes and aircraft carriers. He does now.
Well, so Greg, at the end of the day, the challenge is for you. The challenge is for me. The challenge is for the thousands of people that will watch this discussion to try to figure out how they can best protect themselves from these events that are most certainly coming in one way, shape, or form or another. That's going to be the challenge, because if we're talking about this kind of global monetary system reset and how will the Chinese respond and all this kind of stuff, well, I can assure you that under those circumstances, tomorrow is not going to be just like yesterday.
Well, I want to get into the whole, people like, me or TF Metals report, but I'm a believer in, I just look at all the assets. I mean, do you want a bond? I mean, do you want a stock at sky high prices? Do you want to, I don't know. I mean, I guess you should have a little something, a little bit of everything. But, I mean, don't you want hard assets? I mean, that's what rich people are doing. I mean, Captain Austin Fitz, who flies all over the world, and I have a lot of respect for, he's a financial advisor, said, in the last 10 years, rich people have doubled their land holdings.
Oh, well, yeah.
Doubled their land, that doubled their Bitcoin. They doubled their land holdings.
Well, and I'd put that in the category of, Greg, who has benefited from all the QE in the last 10 years? I mean, there have been studies now that are getting published. The only segment of society that has benefited financially from all of these bank rescues and TARP and deficit spending and everything else, QE, is the upper 10% of the net worth holders in the world, not alone just the U.S. Everybody else is getting their clock cleaned because of the devaluation of all these currencies that are due to all the printing of the money. So yeah, that doesn't surprise me that the rich are getting richer and moving into land and all that kind of stuff. I would just give you one further thing for people to think about, though. What people need to understand, everybody listening to us, when you transact for land, and land costs are going up, agricultural land, real estate, and all that kind of stuff, nobody's buying land derivatives, okay? Nobody's buying just simple land exposure or art exposure or land ETF exposure, okay? They get the real damn thing. All right. In gold and silver and the precious metals markets, nobody owns the real thing. All these investors own garbage. They own fake derivative exposure. Almost swore.
You can say crap.
Crap. That's what they own. They think they own gold. Their bank tells them that they own gold. Oh yeah, you can stop by, UBS anytime you want in Switzerland and you can cash out your gold. Right. That sounds good until you show up and you actually try to do it. Everybody owns this digital form of precious metal that the banks have created and levered up the existing metal 10, 20, maybe 100 times, meaning that there are 100 prospective owners, 100 people that think they own the same one physical ounce, okay? There's no 100 people that think they own the same acre of land.
That's
right. That stuff doesn't transact the same way. Gold and silver do, and that's why gold is sitting here at $1,280 an ounce, because there are all these other varying make-believe forms of gold that people own. There is a day coming when somebody's going to call the bank to the carpet on this. They're going to go in and they're going to say, okay, I'd like my 100 ounces of gold now. I'd like my 1,000 ounces of gold now. And their bank, UBS, JP Morgan, Deutsche Bank, whomever, these bullion banks are going to go, okay, sign here and we'll get it to you in 90 days. And that person is going to go, whoa, wait a second, time out. No. It says here, I own 1,000 ounces of gold and I want my gold. It's kind of like the people that show up at George Bailey's building a loan, right, on his wedding day.
Yeah.
They all want, when the time comes, as long as nobody's making a run for it and everybody knows that, well, your money's invested in Bob's house and your money's invested in Mary's house. As long as nobody wants their money right away, then George Bailey can run a fractional reserve system of savings like that. It's when somebody finally shows up and says, no, wait, I want my 1,000 ounces now. I want my metric ton now. That's when this whole bullion bank system collapses. And suddenly we get a realization where land trades directly, dollars for the asset, where art trades directly, dollars for the asset. Suddenly gold and silver trade that way as well.
That is a brilliant little tutorial on what's going on. Really brilliant. I've never heard that before. I've been doing this for years. I've never heard that before. Which is, yes, grasshopper. Yes, yes. It's like Helen Keller in water, under the thing. Oh, water.
Well, and so that's the thing we talked about earlier about the Swiss National Bank and other central bank actors propping up Deutsche Bank stock, which to me is obvious what's going on. And they're doing so to maintain this illusion of confidence so that there's not a run on the bank. Same thing is said for the price of gold and silver. If you can create all these derivative forms of exposure to the price to satisfy demand, say, oh, you don't want to own the physical thing. It's too expensive to store. It's too heavy to lug around, all that kind of stuff. Just take this this promise that you do actually own it. Hold this paper instead. You're fine. Okay? They promoted that system and created all of these other digital ounces to suppress price. And again, maintain confidence in the system, because what they don't want, they being the politicians and the central bankers, they don't want a run of confidence on the entire system, not just on Deutsche Bank, on the system as a whole. If gold right now were going up $100 a day because it was trading on physical only and it's moving through whatever price level and soaring, people go, oh God, what's going on? I'm looking at myself. I made like the Picasso scream face, right?
Yeah.
That's what people would be doing. And it would be this sign that everything's falling apart. But as long as you can feed pretend gold and pretend silver to the masses and create this illusion that, well, gold's not moving up, so I guess everything must be okay. That's how that game is played too.
Everything's not okay. If they start with if they raise interest rates, Mandarino told me, he said they're going to have to raise rates. I'm not sure they'll raise rates before the election. If they get into trouble, does that when all Hades breaks loose with gold and silver? If they get into trouble and they start stopping the interest rate and they start reversing and cutting, is that when they're not going to Katie bar the door? They're not going to be able to manipulate that and hold the line on that. Is that what you think?
Yes, Greg.
Do you think that's coming sooner than later? Because, wow, I mean, you have big banks in big trouble.
Well, this has been my position all year. Again, we got to try to look forward, right? We can't just simply, be the wizard of hindsight and talk about, well, here's what happened today. That doesn't do it. You can get that anywhere. What I try to do is look forward. I've been doing this now for almost 10 years, right? So I've got a pretty good memory because this is all I do. And I remember what it was like in 2009. I remember what it was like in 2010, and I remember what happened in 2011. If you go back to 2009, remember the term green shoots, right?
Yeah.
Remember that was CNBC that, oh, look, there's green shoots in the economy, meaning there were weeds growing out from the, the rubble of the economy. Oh, here come the green shoots. And by about this time in 2010, middle part of 2010, allegedly one round of QE had come and gone. Ben Bernanke sat there and said, no, we're never going to monetize the debt. This is just a one-time deal like TARP. And then there was all this green shoots and everything was great. Not coincidentally, in the first half of 2010, the price of an ounce of silver trading on the COMEX was roughly between $16 and $18, fluctuating back and forth. Then what happened? Well, by late 2010, it became apparent that the green shoots weren't going to be enough and that the banks needed more cash. And guess what? QE number 2 was announced in November of 2010. And it was then that the price of gold and silver began to take off, and silver basically tripled in 6 months. Gold went from $1,200 to $1,900 in about 10 months. That's where we are headed, where 2018 is a lot like 2010. Oh, everything's great. Look at the economy. Oh, look at everything just going great. Can you believe how great this is? The second quarter GDP is going to be 4%. Again, Fed cannot continue to hike rates without crashing the economy, one way or the other. When they do, the discussion is going to turn to cutting rates. The discussion is going to turn to supporting the bond market, buying more QE, issuing more dollars to make that happen. Suddenly 2019 becomes a lot like 2011. That's how I see it. Again, you look today and you see what's happened to gold over the last 2 months as the dollar has rallied. I think that's a transient deal. I think the dollar eventually goes back down. For risk to it, from political risk of the midterm elections, the geopolitics of stuff that's going on, the de-dollarization risk, the trade wars being a part of it. I think the dollar resumes its move downward and the metals begin to rally with increasing momentum. Even this digital form of metal, that you see priced on the COMEX, it begins to rally. And I think we have a pretty good, not only back half of this year, but next year too.
Do you think the stock market will continue its? I mean, right now they're freaking out. They're like, "Whoa!" They got somebody who's actually going to fight a trade war. I mean, Trump actually told everybody, "Let's just drop all of our tariffs." There's all these tariffs on U.S.
Yeah.
U.S. is fighting big tariffs. I mean, we've always had big tariffs. We have a lot of cheating. China coming into Canada and Mexico,
Right.
dumping their stuff, under the NAFTA flag. A lot of cheating. That's what Trump hates. The deals are sour in one way.
Right.
And he knows we're going to have to dig ourselves out of this mess at some point. He knows that. So he's
So
saying we need to bring our jobs here, and this is why. That's what he's doing.
Absolutely. And I think, Greg, hold on. I'm going to lean forward because I'm losing my battery on my computer. So apologize. You can edit that out.
No, I'm not going to. I'll just leave it. Fine. So, but he knows that. I mean, that's what he knows. The big picture, and the big picture is this debt's going to be reset. He's going to likely be president. I'm pretty sure. And we want him rather than Hildebeest. I mean, Hillary she'd sell, Hawaii. She would cut off Alaska and give it to the Russians. I mean,
but again, Greg, all of those points make sense, but to go from point A to point B in that scenario is a pretty ugly process. I mean, that's not.
Yeah.
That ain't gonna be something that's like, oh, hey, no problem.
You better own your stuff.
A day later, the stock market is moving even higher. Maybe it would, and no one should be under any illusion. I mean, the stock market is not. It doesn't trade on fundamentals either. I mean, what? I mean. I can't even remember what the latest percentages of stocks that are down on the year. The breadth, as they call it, with a D, breadth, is horrible. I mean, the only thing that's going up are the FANG stocks, the Facebook, Amazon, Netflix, and Google, and that's carrying the indices higher. And so that too, though, creates this same illusion of prosperity. Well, everything must be okay because my 401k is still hanging in there, and that's all part of the policy of creating this. Maintaining, let's put it that way, this illusion that all is well. But yeah, what you said makes sense. There needs to be a reset of some kind. There needs to be a distribution of the responsibility for providing the world's reserve currency. The U.S. cannot continue to do it. Our turn and time at it is almost up. But getting through that process, getting through that transition, well, it usually comes with a war of some kind. But two, it's not smooth. It doesn't just, hey, you wake up one morning and it's seamlessly one system is connected to the next. So if Trump's going to take us down this path over the next 6 years, it's going to be a pretty bumpy ride. One of the things anyone can do to prepare themselves and to get themselves some financial protection is, honestly, seriously, the acquisition of some physical metal. Nobody takes their entire 401k and cashes it out and goes buys a bunch of silver coins. Just as you wouldn't take your entire 401k, cash it out, and buy Facebook. But if you want to diversify yourself into sound money, what has been considered sound money for thousands of years, you'd be absolutely crazy not to take this discounted price, this price that is determined through the trading of these derivative contracts, futures contracts that aren't even real metal. You'd be crazy not to be taking some of your dollars and putting it into the physical metal. That's what the Chinese are doing. That's what the Russians are doing. If these creditor nations are converting their dollar reserves into some precious metal, don't you think everybody listening to us should do the same?
Catherine also Fitz advises rich people, and the rich people are doing something amazingly simple. They're owning their stuff. They don't have a mortgage. They're buying land. They're buying businesses. They're buying gold. They're buying silver. They own companies outright. Warren Buffett was famous for owning, I want all the stock of the company. I want the whole.
Greg, look at the flip side of that. Again, when we talk about debt jubilee, right, and resets, okay, that helps the debtor to some extent. But look what it does to the opposite side of that, the creditor. The creditor is the one that gets crushed. So it's not like you can just wave off, your mortgage debt, wave off, your government debt, and just come out the other side, with everybody happy.
Yeah, no.
There's somebody that owns that debt.
Yeah,
and so
he may end up owning your house.
In the end, as the individual, the best thing you can do, is get yourself out of debt. No doubt about that. And then again, I just think this is one of the easiest, simplest things that for people to consider. If the Russians, whatever you think of them, or if the Chinese or the Indians or the Turks or whomever are taking their capital reserves, their dollar reserves, and moving at least some of it into physical gold. Why wouldn't everybody listening to us that also holds dollar reserves, that's what your savings are, why wouldn't you do the same thing? I mean, do you think maybe they're at least have some idea what they're doing? So
Yeah,
you leave it at that.
Yeah, all at the same time. Craig Hemke, TF Metals Report. Craig Hemke. This was very interesting. Just really very interesting. Very good tutorial on people. When people buy land, they don't buy a derivative. They buy the land out with the title.
Right.
Right. They buy a house. You don't buy a derivative and live in in a paper asset of that house. I want the house.
Yeah.
So anyway, listen. Excellent. Craig Hemke, TF Metals Report. I'll put all the links up. Craig, talk about your, you have a subscriber page. I get paid nothing for pitching this, and I'm not really pitching it, but I want you to talk about your subscriber page,
Yeah.
and I'll put a link up for that too. You have a subscriber page and a subscriber community, which lets people get in there and work it out and talk about a lot of stuff. Tell me about your subscriber page.
Yeah, well, it's $12 a month. Okay, so it's not like some big deal breaker. But I mean, I got to keep the lights on. I got to pay my health insurance. I got to pay my own mortgage. Okay, so running a website ain't free. So,
Yeah.
but what people get for the $12 a month is one, access to the community, which is, over 1,000 people at this point who all believe, kind of look at it the same way. We're all there to support each other and keep each other sane as we go through this process.
And you have content too that you put out though.
Oh yeah, I mean every day I put out, I analyze the price. We do podcasts every day as well. And what people use the service for, frankly, is to time their physical purchases. I mean, if like last week, silver was up at 1735. If you knew the history over the last 4 months, you had a pretty good idea that it was going to fall back. If you were going to buy yourself, say, 100 ounces of silver last week at 1735, but instead you read my stuff and decided, I think I'll wait, see if it pulls back, you could buy it today at 1635 and save yourself $100.
Yeah, there you go.
So that's what people use the service for. So if you can save yourself $100 and it costs you $12 a month, I think that's pretty good bargain, and that's what we do.
But don't sell your content short. I mean, I just listened to you for 31 minutes or something, and that's good content. I mean, this is good content. So I wouldn't sell your content short either on that site either. But anyway, I'll put the link up for the subscription page. TF Metals Report. Craig Hemke is the man that runs it. Thank you for joining us today on USAWatchdog.com.
Always a pleasure, my friend. All the best.